Money is very vital for our existence and every type of economic activity. But money has changed its fully secured status, backed by gold and silver, to free floating paper currency. The only limitation as of now today we have is a fractional reserve system, under which banks are required to keep a certain percentage of their deposits as reserve and lend only the remaining portion.
The detective $1,000 to trace what happens to the money after depositing it in the bank. He started with the fractional reserve bank and deposited $1,000 there to open a free account. The bank told him that all of his money is still available to him on demand. He can withdraw his deposit at any time. Our detective suspected, however, that he should take a closer look, or else he wouldn't get paid for his detective work. With a little research, he discovered that the bank only holds a part or a fraction of deposits in reserve, and that this fraction for this bank was 10%. The detective watched the teller and noticed that instead of safely depositing the entire $1,000 in the vault, she only put $100 in the vault, and then gave the other $900 to another bank customer who was asking for a loan to purchase a new TV. Something's fishy, thought the detective. Let's see what happens next. The detective followed the borrower to the electronics store where he bought the TV for $900. The store owner took the $900 he just earned from the sale of the TV and deposited it in the same bank. And the bank told him the same thing they told the detective. All of your money is still available to you on demand. You can withdraw your deposit at any time. And again, the teller took 10% of that $900 and placed it in the vault, but gave the other $810 to another borrower to buy a nice new leather jacket. Moments later, the seller of the leather jacket walked into the bank with the $810. The teller put $81 in the vault and gave $729 to another borrower. This time, an elegant lady who wanted the money for a new purse. The process repeated itself over and over again until the original deposit of $1,000 had created $9,000 additional dollars. The detective, after running around the city all day, came back to us with 4 conclusions. Conclusion number 1. The account was free because the bank makes money off lending deposits to other people. However, if everybody came to withdraw their deposits at the same time, the bank would be in big trouble. Conclusion number 2. The bank earns interest on the newly created $9,000, but the real deposit was $1,000. A little strange, isn't it? Conclusion number 3. As we know, money itself is not real wealth, except that it allows us to purchase the goods and services we actually want. By creating a larger money supply and not a larger supply of goods and services, prices of goods and services increase and the purchasing power of all the money decreases, including the old money that originally existed before the fractional reserve lending process. Conclusion number 4. The lower the fraction of reserves held, the more the bank can lend to others. If the fraction was 5% in this scenario, $19,000 could have been created out of thin air.
The fractional reserve system. In India, it is at 22%, composed of cash reserve ratio at 18%, the statutory liquidity ratio at 4%. In most other countries, it is around 10%. Thus, in India, money multiplying effect is limited up to 5 times their deposits. That is, with a deposit of 1,000 rupees, banks can lend up to 5,000 rupees. This type of money multiplication causes inflation continuously. However, with the revolutionary progress that we have achieved in information technology, the possibility of finding out a solution appears to dawn in the horizon. The social media that has emerged out of the internet requires that individuals be identified uniquely without any tags attached to their identification. That has already happened today, and many people are identified only with their email IDs and nowadays only with their mobile numbers. This is very helpful and goes a long way in the future for establishing peer-to-peer communication without involving any type of intermediaries for financial settlement and even conducting e-commerce.
Double spending. Now, what's that? Let me explain through an example. If a person buys a sandwich worth $10, for instance, they cannot spend that same $10 bill anywhere else. But when the same amount is paid digitally, some people can manipulate systems and spend the same $10 more than once. And that, in simple words, is double spending. To stop this from happening, you have banks and credit card companies acting as middlemen. So they vouch for the transactions that you make, and they prove that you've already paid for something. At the same time, they take their own cut of the transactions you make. Enter Bitcoin. It solves both these fiddly problems. Like I said, it is decentralized, meaning there is no third party controlling it. Instead, it is regulated by its own community of users. And all of them record all of their transactions at the same time. Any attempts to fool the Bitcoin community will ideally get noticed, and the payment will get rejected. No single user or government or bank or credit card company can force a fee on your payment or control its flow. Plus, Bitcoin is said to be secure from the effects of currency debasement and inflation.
It is a very strange and interesting coincidence that COVID-19 has encouraged online work tremendously. Many people have been able to establish their own business online and become independent of intermediaries. The future life is entirely dependent on individual people and not intermediaries.
India is undergoing what we can call a digital payments revolutions. A recent report by the US-based payment system company ACI Worldwide revealed some really interesting numbers. India is currently leading the e-payment sector in terms of transactions. In 2020, 25.5 billion real-time payment transactions were made. India has left other countries far behind. China tries behind with 15.7 billion transactions, followed by 6 billion in South Korea, 5.2 billion in Thailand, with the United Kingdom recording 2.8 billion transactions. The US came ninth with 1.2 billion transactions. Over the past 250 days or so, the growth in digital payment sectors has been spectacular. Between November 30, 2020 to August 6, 2021, digital transactions grew by 80%. Home services industry like plumbing and carpentry is relying on e-payments with a growth of 138% in the said period. The Reserve Bank of India's Digital Payment Index, an indicator of adoption of the online payment system too, jumped by 30% between March 2020 and March 2021. Meanwhile, the e-payment sector is expected to grow even more sharply in the upcoming years. Online transactions will occupy a 71.7% share of all payments in India by 2025. Cash and check-based payments will be reduced to 28.3% of all payments. Currently, 6% of total payments are made through instant payments, 22.9% of payments are made through other electronic means, and 61.4% of the payments are paper-based. The Digital India movement and announcing demonetization in 2016, which led to people adopting instant payment apps. However, it was the Unified Payments Interface, also commonly known as UPI, that truly revolutionized the way Indians make payments for their purchases. Launched in April 2016 by the National Payments Corporation of India, also known as NPCI, UPI has enabled both interbank and person-to-merchant transactions. UPI has been so impressive and successful that Paytm, Walmart owned PhonePe and Google Pay also adopted it. Today, UPI is the most preferred system of instant payments in the country. because it does not operate as a digital wallet and enables seamless transfer of money into bank accounts. As of March 2021, UPI accounted for 2,732 million transactions worth rupees 5,04,886 crore. As the economy is being forced to turn cashless, the benefit of a formalized payment systems are also going to emerge. Monitoring cash payments isn't easy for government agencies, but with cashless payments, it is going to become a lot easier for the government and security agencies to track money trails and crack down on menaces like terror financing and black marketing.